Now is it audible? Please confirm. Is the voice audible now? Let us start. Just very good evening, everyone. So this is a high time for your preparation. I don't want it to waste even a single minute of yours. I don't know how much time this revision session will take, but this is a very quick revision of all the concepts applicable for your FM examination from the point of view of the formula, understanding, and how to present an answer if comes in exam. These are the things that we are going to concentrate in the today's session. Okay. I'm not going to tell any logic behind any formula. Don't expect all those things in this time. So you are having a very little time because another subject is also there for you, which is bundled along with FM, which is SM. So you are having a short of time. I don't want it to take even single minute extra. Okay, this is also only to tell you what I am going to do in this particular session. Okay, so be serious. Let's complete all the chapters, the formula, their application if they comes in examination, how to present the answers. Clear? Are you all clear? Shall we begin? Yeah. So when it comes to the FM paper, first point number one, The time that is available for you today, you can work out for at least 4 hours, starting from now. In that 4 hours, give me 1.5 hour time. I will quickly revise all the concepts applicable in your FM. Okay. I'm not going to just tell you the summary. I will cover each and every minute detail. If they comes in exam, how to present the answer. Okay. Because I know all the questions which came in the RTP, MTPs and past exams everywhere. So I know which adjustments they will ask. So I will first summarize each and every topic. If you listen to this lecture, tomorrow when exam paper comes, whatever we said today, the voice over also you will listen in the examination question paper. Means the adjustments we are going to do now. If this question like this adjustment comes, how I have to react in the exam. This is what we are going to target. So I will start with the following chapters. When you prepare, also do the same. First, so many students started requesting me, sir, start first with cost of capital, capital busting like that, sir, because working capital is coming only for 6 marks in exam, but these all are coming for around 30 marks in exam. So I will go as per your request. First one, cost of capital, a compulsory 6 marks to 8 marks. First, I will start with the cost of capital. Second one, we will start with the area called as a capital structure because every attempt 7 marks are coming from this chapter. So these two chapters are accounting for 13 marks in exam. So first let us try to understand what are all there in this particular chapter. In the chapter cost of capital, in the chapter capital structure, what are all the important things and adjustments that we need to remember. Okay, let's begin. And again, this session will be a 1.5 to 2 hour session. If you understand this entire 2 hour session, you will also work out along with me now. Once you do all these things, you are half done with your FM. I mean it. So when you start your live, continue along with me till I close the live. In middle, don't go because day after tomorrow is your exam. So please be serious. Do along with me. First summarize everything and complete entire FM. Okay. After that, practice will begin. Okay. How to use this particular session, I will explain. Just I will take 1 minute time. Cost of capital chapter is there. I will take cost of capital chapter now. Each and every formula, how to apply, what are all twisted points they will give in exam, I will tell you. Once after I complete, that chapter will be completed, cost of capital. Next, I will go to capital structure and I will complete. Then what you have to do, once my entire life is completed now, then you will start doing the problems on those chapters now. Okay. Then you are half done with the area. So I will complete the formula, its application, the most important and dangerous point they will ask in exam. After that, you need to just practice the problems and complete. So you will be half done if you complete the revision properly. So stay live from the beginning till the end. It will be extremely useful for you. Okay, let's begin. So see here, first of all, with regard to the cost of capital chapter, see, see the screen. First point number one, they will ask a question on debt. Technically, they will ask about KD. KD, two types of questions can come. One, irredeemable debt. Another one, redeemable debt. In irredeemable, with flotation cost. In redeemable, with flotation cost. Means they can ask four kinds of questions on KD. Normal KD irredeemable, normal KD redeemable. I repeat, normal KD irredeemable, normal KD redeemable. KD with flotation cost irredeemable, KD with flotation cost irredeemable. Okay. Now question. What is the formula for irredeemable? KD equal to I into 1 minus T. When they say T, they will confuse you. They will use two tax rates. One, corporate tax. Two, personal tax. Corporate tax only should be considered here, not your personal tax rate. Definitely, they will confuse you like this. They will give you corporate tax rate 35%, personal tax of the investor is 25%. Now, student will get confusion in examination hall. Which one to apply in the formula? It's a common sense. Why? KD is cost of debt. It is a cost to the company because if an investor invests in the debentures, whatever I get is a return. It's not a cost. It's a cost to whom? Company. So we are looking for this formula from the company point of view. So for a company, corporate tax will apply, not your personal taxation. Hope everyone in the class understood the logic clearly, right? Fast, fast, fast. Everyone. Yeah. So therefore, every calculation must be from the company point of view. So I into 1 minus t whole divided by np. This is without flotation cost. If flotation cost is given, then reduce the flotation cost from the np. Again, I'm telling, np means what? np represents market price today. I repeat again, don't make mistakes in exam by writing par values there. NP represents net proceeds today. Net proceeds today means what? Proceed means what? Net outflow. For example, I'm an investor. I have to purchase a debenture. At what price I will purchase? At the market price I will purchase. Okay. Next, you gave 100, but company have utilized 2 rupees out of flotation cost. So you gave 100, company utilized 2 rupees as a flotation cost. Net proceeds is only 98. That's how the word net proceeds came. So net proceeds represent market price of the particular bond given in the question. Okay. Now, question number two. What confusion point they can ask in exam? Whenever they say flotation cost can be given in two ways. Number one, amount. Number two, percentage. If they give an amount, the problem will not be there. Why? You will write here some 85, 90, some value they will write. Minus that flotation cost 3 rupee, 4 rupee, you will write. Answer is simple, everything is done. Okay. But when the problem will come, when the flotation cost is given in the question as a percentage, when they give flotation cost as a percentage, on what you have to apply that percentage? On par value you have to apply, or on market value you have to apply. If nothing is said in the question, flotation cost is always applied on issue price. Always applied on issue price. Issue price means in the question they will give par value 100, issue price is 90. On that 90, you have to apply that percentage of flotation cost. If nothing is given in the question, sometimes they will clearly tell in the question, apply the flotation cost on par value. Then you have to apply the flotation cost on par value only. These are all certain dangerous things you need to keep in mind in order to score good marks in this particular area called as KD irredeemable. Next one, KD redeemable. The only difference that comes is in case of KD redeemable, redemption value, net proceeds, both will come in the formula. I into 1 minus T plus RV minus NP by N divided by RV plus NP by 2. This is called as interest after tax. This is called as capital gain per annum. Okay, RV, sale value, NP, purchase price. Sale minus purchase price is called as capital gain. Divided by N means per annum capital gain. So per annum capital gain plus per annum interest after tax whole divided by average price. This is without flotation cost. If flotation cost is there, what will happen? Instead of NP, you will write NP minus flotation cost. Instead of NP, you will write NP minus flotation cost. Wherever flotation cost comes, it can be rupee or percentage. Rupee na problem illa. If it is a percentage, then on what we need to apply percentage? If nothing is said in the question, apply on issue price. If clearly given that it is on some value like par value, apply on the par value. Next stage. Whatever you calculate using this is a approximate formula. So whatever, for example, I got 11.37, some random number. What to do next? Next, you need to calculate IRR. You need to calculate what? IRR. This is also called as a YTM model. Which model? YTM model. How to do YTM model? See, you have to open 6 columns. Year, cash flow, PV at the rate of some percentage, PVCF. PV at the rate of some percentage, PVCF. So totally 6 columns you have to open. Assume two PV factors. How to assume two PV factors? Always easiest method is you got some approximate value. Na? In my example, 11.37. Na? Take 1% below that, round it off. So 11 ki 11.37, make it 11. 11 ki 1% below, 10. 11.37, next number, 12. So take 10 and 13. Easy, na? So take 10, take 13. Two values you take. PV at the rate of 10%, you will get one value of a bond. PV at the rate of 13%, you will get another value of a bond. These two bond values must be, okay, one should be higher than the NP, one should be lower than the NP. Repetition one more time, listen carefully. You assume two PV factors. One should be higher than that 11.37. Example 11.37. Don't mug up and write down in exam 11.37. Okay. So point is 11.37 is our approximate answer. Now what you need to do? 11.37 is an approximation. You assume one rate below. Take 1.5% or some percent below that. Take 10. Take 13. Take 13. What we need to do? PV at the rate of 10%, you will get PVCF one value. PV at the rate of 13%, you will get another PVCF value. These two are two different values that you are going to get. One should be higher than the NP given in the question. One should be lower than the NP you have given in the question. You have to extrapolate both the answers and then you have to calculate the accurate YTM, also called as a KD. Everyone understood the entire sequencing and the concept clearly? Yeah, everyone. Up to here, everyone. So very, very important adjustment. So please take care. Next one. Cost of preference. Cost of preference. So just for your sake of understanding, not to take your time, I will just to show you the format of IRR. Okay. Mug up. Literally mug up. Because there is no other option available for you. See, I got 10.77 approximate. What you need to do? NP 95. Okay. Target simple. You got 10.77. Take 9, take 11. I have taken two rates. 9 I got 106, higher than 95. Okay, next 11%, lower than 95. Okay, PV 9% ki 106, 11% ki 94. Ante 2% PV factor changed. Value of the bond is changing by 12.29% or 12.29 rupees. Okay. So value of a preference share, value of a bond or preference, whatever the case may be, 106.38. We want 95. So for this, the change is 11.38. If 2% change in PV factor leads to 12.29 rupees means for 11.38 rupees, how much PV factor should change? So it is 1.85. So 9 plus 1.85, 10.85. That is how we need to calculate. This calculation is very, 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 very important in the exam. Almost every attempt they are asking a question. But one very, very important thing, my dear students, I am telling you, listen carefully. When they give question on KD or when they give question on KP, in both the cases, approximate and accurate, you have to calculate. But please do remember carefully one point. Target is NP. Okay. You will take the approximate PV. Now you will take one rate below. I took 9. I took 11. You can also take 12. No problem. Okay. You will get two values. One value should be higher than 95. In this example, 95. Okay. One value should be lower than 95. Extrapolate, do these calculations and solve. Institute material, they will use a formula. We don't need not even use the formula. Directly you can do this way. Okay. Next, KP. KP also same calculation, ditto, copy paste with a minor change. See, KP, irredeemable KP, PD by NP, PD by NP minus FC, irredeemable. Redeemable na same formula. The only difference between KD KP is tax will be there in KD, tax will not be there in KP. That's it. Remaining everything is same. Next, equity. Mark it very, very important for the exam. Equity. Whenever question is given on equity, remember one point. There can be five different kinds of questions they can ask you in exam. How many? Five. Number one, constant dividend model. Which model? Constant dividend model. Simply 2 rupee, 2 rupee, 2 rupee, 2 rupee forever. They will tell. Okay. Price they will give. Per annum dividend they will give. This formula. Instead of giving dividend, sometimes they will give earnings. Then E by P. Constant growth. D1 by P naught plus D. Don't ask logics now. This is not the time to learn logics. You know that very well. We are at the edge of exam. So here D represents dividend. P represents a price. D1 represents expected dividend. Always expected dividend means D0 into 1 plus G. Okay. P naught means the current market price. G. B into R. If G is directly given in the question, 2%, 5%, 7%, write down. If they don't give, they can give G in two ways. Number one, they will give you retention proportion and return on investment. Okay. Then B into R. B means retention proportion. R means rate of return. So you'll multiply both and calculate G. That's one way. Sometimes G can be calculated also through the prices changes. P1 minus P naught whole divided by P naught. This is called as the growth in the share price. Means when a person invests in a share, he will get two types of returns: dividend return, capital appreciation return. Dividend return is D1 by P naught plus G is the capital appreciation. Capital appreciation means what? I invested 100, it became 120. What is my return? 20%. At 20%, we have written as P1 minus P naught whole divided by P naught into 100. Okay. So this is another way. So in case of KE, they may give D by P, they may give E by P, they may give D1 by P naught plus G without flotation cost. With the flotation cost, wherever P naught comes, write down P naught minus FC. That's it. Realized yield approach. Very, very important area 11. See, KE equal to D by P. Okay. The dividend we are expecting on a price, earnings expected on a price, dividend expected on a price with growth, dividend expected on a price with growth with flotation cost. This is not expected, this is already happened. That's called as realized yield. If the data given in the question is relating to the past, if the data given in the question is relating to the past, means how they will give 2022, 23, 23, 24, 25, 26, like the 3 years data they will give. They will ask how much return he made. How much return he made means already that years are completed years. Whenever year is completed, I already realized my yield. Yield means return. So K equal to D1 plus P1 minus P naught whole divided by P naught into 100. On a yearly basis, you will calculate. Okay. CAPM, K equal to RF. RF means risk-free rate. Beta, they will give in the question beta. RM, market return. RF, risk-free rate. RM minus RF is called as a risk premium. RM minus RF is called as what? Risk premium. Everybody in the class, please reply. Understood the point clearly? Everybody reply. Understood up to here? Yeah, done, done. See, so we completed this. I will show you one question from realized yield such that you can understand in a much better way as to how they can ask in exam and how you have to react for that question. Okay. Everyone, please listen carefully. This is an expected adjustment in the coming exam. Okay. When I say expected adjustment, mark it important. Which one? Realized yield approach. Expected question in the exam, this attempt. So let us see how the question can come. See here. Hmm. See the screen. See the screen. This is illustration number 11 from page number 4.24 in your study material. Okay. See, they will give data this way: D1 dividend received, P1 price at the end of year, P0 purchase price. Okay. Then return 19.44%. How you got this 19.44? You can take calculator and see. D1 plus P1 minus P naught whole divided by P naught means I purchased the share at 9 rupee. Okay. Share at 9 rupee, received dividend of 1 rupee. sold at 9.75. I made a return of 19.44%. Okay. I purchased at 9, I sold at 9.75 by receiving a dividend of 1. Again, I repurchased at 9.75 and again sold at 11.5 the next year. Like that, you will calculate the returns. Okay. Now he will ask a question. These are all called as individual per annum returns. These are called as what returns here? Individual per annum returns. Means concentrate and try to answer with common sense. Today, I have 1 rupee. My 1 rupee will become 1.1944 at the end of first year. Okay. By the end of second year, you can take calculator. Take calculator once. Everyone take calculator. Take 100. I invested 100 rupee. I invested 100 rupee. How much return we made in the first year? 19.44% plus 19.44%. Ante my 100 has become 119.44 at the end of first year. Again, I made a return of 28.21 plus 28.21 percentage. My 100 became 153.13 by the end of second year. Again, I made 6.09%. My 100 rupee has become 162.45 at the end of, or 162.46 at the end of third year. Plus again 7.73% return I made. My 100 became 175 rupees at the end of 4 years. Okay. There is a formula na FV equal to PV into 1 plus R whole power N. Okay. 4 years after 175 is the future value. For what present value? 100 plus 1 plus R whole power 4. Okay. 1 plus R whole power 4 equal to 1.75. 1.75 fourth root. 1.75 2 times square root. 15% is the answer. That's how we got this answer. Hope everyone understood clearly how to do the question if they given in exam. Respond, everyone. Understood the adjustment. Here, done. So you understood the realized return concept. Okay, if the data is to the past, you should use that. Next, CAPM, you know that already I have given here. Next, very, very important is KR. Listen first, 2 minutes discussion. After that, you can directly understand. Whenever question is given in KR, I'm talking with you only. Listen carefully. Whenever KR is given or whenever retained earnings is given in the question in the exam, first observation, don't panic. First observe. Is there any new issue given in the question? What do you mean new issue? Already company retained earnings are there. Again, company is going for a new issue. Okay. Is there any adjustment relating to new issue in the question? No, sir, nothing is there. Then happy. KE you calculate anyway, you will calculate KE na KE KR. Okay. So first case, if comparison is between old KE and old KR, both are same. That means all aforesaid 5 models can be used for reserves also. So whenever question is specifically on, okay, normal retained earnings and normal equity, then blindly KEA KR. Yeah. Okay, no change. However, if company is going for a new issue, company is going for new issue of shares, flotation cost will be there, broker charges will be there, personal tax of the investor will be affected. In such case, KE and KR will not be same. Okay, KE and KR will not be same. KR will be the old KE will be the new KE. Both will not be the same. What I said? Normally, KR, KE both are same. When there is no new issue. If a new issue is there, new issue KE and old issue KE both will not be same. Old issue KE is the KR, new issue KE is the KE. Both will not be same. KE for the new issue will be more than KE for the old one. Simply to tell KR will be lesser than KE in that case. See, special case. If comparison is between new issue KE and KR, both are not same. In such case, KR is as follows. KR equal to KE into 1 minus flotation cost into 1 minus brokerage into 1 minus, when I write a tax here, It represents personal tax. என்னப்பா புரிஞ்சுதா? So it is not corporate tax. It is personal tax. Okay. Why? This is not the time. Okay. Just mug up. Remember, exam question comes, you should be solving. Ante. That is our intention. Okay. Beyond that, nothing. No more great intentions for today. Question comes, my student should do. He should get good marks. Ante. Ide target. What is there behind? This is not the time. Okay. So what is the formula for KR? KR equal to KE into 1 minus flotation cost percentage into 1 minus brokerage percentage into 1 minus a tax rate. Okay. Tax means which tax? Personal tax. Everyone clear? Clear up to here, everyone? Can I move to the next formula? Ah, everyone, give a reply, give a reply. Be active, yeah. Exam time, be active. I'm having hundreds of work. I'm only sitting means you should be more active. Ah, so everyone, Sri Raghavan, Prudviraj. Prudviraj, இ- இப்படி இருக்கீங்களா? நல்லா இருக்கா? Done. So let us begin. நன்றி நன்றி. இதை கண்டினியூ பண்ணு. So KR equal to KE into 1 minus flotation cost, 1 minus brokerage. All are percentages again, not amounts. 1 minus tax rate. Here tax represents the personal. Next one. Most important, the dangerous one in this chapter is a WACC calculation. Always remember, whenever question is given on WACC, 99 of the cases, they will give market value weights in the question. What weights? Market value weights in the question. And generally, they don't ask questions on book. They will ask book value. Even though they ask a book value, they will again ask a market value. Okay. What is a book value weight? What is a market value weight? How to understand in a given question? Simple. Simply way. Listen. Question la par values will be given. What will be given? Par values will be given. See, whenever you do WACC calculation, na, four columns you will open, five columns you will open. Sources, amount, proportion, cost, weighted cost. If cost is there, na, if the market value weight book value weight for anything is the same. This will not change. So confusion should not come in KD, KE, KR, KP calculations. The calculations are confusion. So it's romba clear. So the point is what? Problem will not come in cost calculation. KD, KP, KE, KR. Romba simple calculations already we have done now. That calculations won't get affected because of market value weights question or book value weights. Okay, so even though you made mistake in the exam, mistake should be only for calculation, not for the individual cost. Means if you give 8 marks cost of capital, at least you should do 6 marks correct if you do this cost clearly. So cost valuation will not change whether you use book value weights or market value weights. This is the first point. Enappa, புரிஞ்சுதா everyone? Ah, so this won't change. This clarity number one. Clarity if you don't have a clarity, na gone. So cost will not change in any way. Cost will be always same. What will change? These proportions will change. So these proportions, how they are calculated? On the basis of the amounts. Amounts la changes will come. In case of book value weights question, in case of book value weights question, number of shares into book value you will multiply in this amount column. Market value weights, number of shares into market value you will multiply. If you multiply this with market value, amounts are market value, proportion weights are market value weights. If you take book value weights, will be book value weights. That's the answer. Hope everyone clear. Clear everyone. Done. So, where difference will come? So, don't get into depression in exam. Suddenly they will ask question on market value. It's market value. It's I don't know. You know. First, you believe in yourself. You know. They did not ask any kind of rocket science in exam. Even if the question comes on market value weights, cost column calculation la answers won't change. They are same. The only difference is the multiplication in the column number 2. So, see here. Next. If a flotation cost is given in rupee terms, we will directly reduce from the issue price. Issue price 100, flotation cost 4 rupee, 100 minus 496, answer over. Okay. If it is given as a percentage, I told na, if question is silent, apply issue price, apply flotation cost on issue price. And 100, for example, issue price is 90, flotation cost is 2%. Example, okay, 90 minus 90 into 2%, 1.8. Like that you have to do. Okay. Next. Question like they clearly said apply on face value. Then apply directly on face value. You have no option. But generally, this is more viable. Okay. Next. Next one. What I said, normally KE, KR both will be same. KE, KR both will be same. When normally both are same. But sometimes when new issue is made, when what is made here? New issue is made, KE and KR both are not same. In that case, how to do? Please see the screen. A very, very important adjustment. Okay. Exam la expected point la another expectation for this attempt. See, first using market value weights. Using market value. If KE, KR both are same. KE, KR both are same. Separately, you need not take KR directly. You can multiply and you can calculate. If KE is not equal to KR, if KE is not equal to KR, means what? KE 16%, KR 14%, then both are not same. Both are not what? Same. Whenever, remember, mark my words. Mark my words. Whenever, okay, I'm talking with you. Come here. Whenever KE, KR, both are given and KE, KR both are not same, they're different. Say, for example, KE 16, KR 14. Then what to do? Then there is a problem. Do you know why? Let me tell you. Whenever you are using, whenever you are calculating market value proportions and the sources, amount, proportion, market values, whenever you are considering, okay, whenever you are taking market value WACC calculation, separately reserves will not be taken. Okay. Equity market price of the share will be given. In that already reserves are assumed to be included. Okay. Separately reserves will not be taken. Sir, I did not understand. I will show you one question. Apply mind properly. See, this question can get repeated directly in exam. Ah, இதா இங்க பாரு. இங்க பாரு டேய். See, book value 5 lakh. Retained earnings 15 lakh. Okay. First, he is asking you to calculate market value WACC. Which WACC? Market value WACC. Listen carefully. What is the book value of equity shares? 5 lakh. What is the book value of reserves? 15 lakh. Both together, how much? 20 lakh. Proportion of capital to total. 5 by 20.25. 15 by 20.75. Okay. Now listen. If we ask book value weights, take 5, 15 total, 5 by 20.25, 15 by 20.75, apply, multiply with KE, KR, answer over. But if they ask market value weight, market value WACC, separately reserves will not be there. Reserves will be included into the market price per share. Here, what is the market price per share? 50. How many shares are there? 50,000. 50,000 into 50, 25 lakh. In this 25 lakh, KE is there. So in this 25 lakhs, equity share capital is there, reserves is also there. That are assumption. Okay. But KE and KR both are not same, na? Then how can you apply the same rate? KE 16, KR 14. But in this 20, in this 25 lakh, both are there. Then how to apply? Then what to do in the answer is take the market value. Okay, take the market value. What is the book value proportion? 0.25. Apply. 6,25,000 is the market value of the capital. 18,75,000 is the market value of the retained earnings. I repeat one more time, listen carefully. First, they have given you the book values, okay, of capital and reserves. And they ask you to calculate, and they gave different KE and KR. See here. KE is 10.41. KR 10%. Both are same or different? Both are different. If both are 10%, na problem illa. 25 lakh, 25 lakh, 10.41, directly 10.41 is the answer. But here the problem came. KE 10.41, KR 10. Okay. Market value, both are there. How to bifurcate? First point number one. Number of shares. Yes, 50,000. Market price per share, 50 rupee. Total market value, 25 lakh. What is the 25 lakh? It is the market value of both equity share capital and the resource and surplus. Okay, how to bifurcate between both of them and calculate like this? Divide on the basis of book value proportions. So first calculate book value proportions. 0.25, 0.75. You got the 25 lakh, na? 0.25 give to equity share capital, 0.75 give to the retained earnings, and thereby calculate the value, will get KO. Everybody answer, understood the point clearly or not? Everybody understood the concept clearly? Okay. Yeah. So one person is asking a question, sir. What if debt and preference is there? What will happen if debt and preference is there? Equity, reserves, retained earnings, so debt preference you will have. Debt key preference के anyway, market value, book value, nothing change will be there, na. Just you need to apply market values. This bifurcation problem will not come in case of debt and preference. Book value weights they ask now. Book value of debt to book value of equity, then you will multiply. If market values are given, you multiply with market values. I will show you one question. Anyway, you ask the question. Let me show you how the exam questions can come on this. See here once. See here. Here we calculated KD, accurate KD. We calculated KP, accurate KP. We calculated KE with the flotation cost, directly given in rupee terms. Okay. How we have done? WAC using book values. Okay. WAC using book. They only given book values. Okay. They only give market values also. Now we applied market values to this. Multiplied and we got the answer. Clear? Yeah. So this is how we need to do. Remaining all you can see now, whatever we discuss, same adjustments we are going to do here. Clear everyone? Yeah. Now question will come. Sir, entire chapter cost of capital we revised. Then what questions I need to do now? Okay. After you complete this lecture, what questions I need to do? Okay. Compulsory questions to be done. I recommend every one of you. Okay. Put time of 1 hour. After this revision, okay, I will complete another chapter also now. After this revision, you need to spend how much time? 1 hour on cost of capital chapter. Do illustration 17 in your textbook, illustration 18, And question number 1 to question number 7. Each question you should spend only 5 minutes. You need not even do. Observe the adjustments clearly. Do it. Hand notes is available. Observe the answers. Go to the next question. 1 hour time. You need to complete cost of capital after the revision is completed. Are you all with me? One day you properly plan your study. You do it. Success will be yours. If 1 hour life you do some greediness, na gone. Clear? Illustration 17, 18. Question number 1 to question number 7. Super duper questions. All kinds of adjustments will be covered in that. Question number 17, 18. Illustration number 17, illustration number 18. Question number 1 to question number 7. So get thorough understanding of these 9 questions totally. That is more than enough for the examinations. After that, if you want, you can do 1 or 2 RTPs also. And generally, the RTP questions will be repetition of the study material questions. Yeah. Next one. Please open the chapter Capital Structure Theories. Capital Structure Theories. Much more important chapter, intricate chapter. Students are leaving this. Yeah. So see here. First, like any other chapter, let us first revise the formula applicable for the chapter Capital Structure Theories. Okay. Let us understand the formula applicable for the Capital Structure Theories chapter. See here. Concentration. Chapter will come for 6 to 7 marks in exam. Students are leaving for every attempt. They are giving in every attempt. Okay. Consistently, students are leaving. Consistently, IC is giving. Let's not leave this chapter. Very easy. Observation is required. See, first of all, there are 4 ground foundation formulae for this chapter. Without these 4 formulae, there is nothing like a chapter called as capital structures. Capital structure theories chapter is laid on foundation of 4 important formulae. Number 1, value of a company equal to value of the borrowings, value of its share capital. Simply to tell, debt plus equity is the value of company. Then what is the debt? Market value of debt. What is the equity? Market value of equity. Sorry, market value of debt plus market value of equity is the total value of the company. How to calculate that market value of debt? That market value of debt without tax, I by KD. Okay? With the tax, I into 1 minus T by KD. Nothing but it's an interchange of the formula. KD equal to I into 1 minus T by NP. NP is what market value I told. Na? So what is the market value? I into 1 minus T by KD. So as simple as that. Simple formula. Notation we need to change. Okay. Repeat. What is the value of company? Market value of the debt plus market value of equity is the market value of a company. What is the market value of debt? I into 1 minus T by KD. What is the market value of equity? See, this you need to understand one point. How to understand market value of equity? Okay. See, market value of equity. Equity share will give a return called as a dividend. Will give a return called as what? Dividend. What is dividend? Dividend is nothing but division of the total earnings. Division of total earnings. How many years? Perpetual years. There is a formula. Present value of perpetual cash flows equal to cash flow per annum divided by required rate. Okay. Equity gives a cash flow called as dividend. Required rate on equity is called as KE. So dividend comes out of what? Dividend means per share. I want total value. What is dividend? Dividend is nothing but total of all the earnings which are distributed. Earnings which are distributed. Therefore, E by KE, I E by KE, this one. So value of company is nothing but B plus S. Remember, these formulas are how much important. We will solve two, three problems now. In the problems, once we start applying the formula, then you will understand the importance. Okay. Value of company, B plus S. Value of debt, I by KD without tax, I into 1 minus T by KD with the tax. Value of equity, EAESH, earnings available to equity shareholder divided by K. Value of company. Sir, already we calculated. Na? This is one way of calculating. This is second way of calculating. See, debenture holders look for EBIT because interest will be paid out of EBIT. Equity shareholders look for EAESH. Okay? EAESH. Both of them look for EBIT together. Simply, I will tell this way. If EBIT is there, it can pay interest, it can pay dividend, both. EBIT are not there, now both cannot be paid. So therefore, what equity wants is earning. What debenture holders want is interest. What both want, EBIT. Okay. So therefore, value of the company is the cash flow available to both of them. EBIT divided by KO. With the tax, EBIT into 1 minus T whole divided by KO. What is this 1 minus T? The government portion of EBIT will be taken out. Okay. See, KO means what? It is a combination of KE, KD. Government is not an investor in the company, but it takes a tax. Therefore, in KO calculation, government will not come because KE is there, KD is there, KG is not there, government is not there. When government is not there in the denominator, government should not come even in the numerator. There should be a consistency when you follow a formula. Therefore, 1 minus T should be applied also in the numerator because in the denominator, government is not there. Clear? In the denominator, government is removed because in KO, KD is there. KD already taken 1 minus T. Therefore, numerator also you should take 1 minus T. In the total earnings, remove the government portion. Balance available is belonging to both equity and debt. Clear, everyone? Clear, everyone? Understood? Yeah. Next issue. So, next one. Very, 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 very important adjustment in the exam. Value of a levered company. If value of unlevered is given with the tax, whenever you wanted to calculate the value of a levered company, okay, when unlevered company value and the tax is given, value of unlevered company plus total debt into tax. Logics of the formula, please don't ask me. There is a elaborate 1 hour discussion on this in the normal class, but this is not the time. Just to remember, you want the value of a levered company. Sir, I don't know what is levered and levered. Listen, levered company is such a company where both debt and equity are there in capital structure. Unlevered company is such a company where there is no debt in the capital structure. Okay, only equity unlevered, debt and equity levered. Whenever there is a levered company, the value of levered company is always higher than value of unlevered because of the tax saving advantage on the borrowings. So therefore, value of levered equal to value of unlevered. Say for example, 1 lakh is the value of unlevered plus B into T. That's it. If B is 1 lakh, 1 lakh into tax rate is 30%. Now 1 lakh into 30%, 30,000. 1 lakh plus 30,000 value of levered will be 1 lakh 30. Levered will be only 1 lakh. Okay. This is one formula. So tell me, what are all the formula? General value of a company is B plus S. Debt, I by KD or I into 1 minus T by KD. Value of equity, EISS divided by KE. Total value of company with the tax, EBIT into 1 minus T by KO. Without tax, EBIT by KO. Value of levered company, when value of unlevered and taxes are given, value of levered equal to value of unlevered plus borrowings into tax rate is the value. Okay. Next question. Financial break-even point. Financial break-even point. What is the importance of this question? They will give you two important data here, three important data. Number one, they will give you interest. They will give you preference dividend. They will give you tax. They will ask you financial break-even point. Sir, what is a financial break-even point? Financial break-even point is a EBIT point where, I repeat again, Financial break-even point is a EBIT value where EPS is exactly zero. Okay, EPS is exactly zero. Okay, how much should be your interest and preference dividend in order to make EPS zero is called as a financial break-even point. Okay, cost break-even point, that is different. That we will see in costing on leverages chapter, not here. Here we are seeing the financial break-even. Okay, cost break-even, what we will do? Cost break-even, contribution minus fixed cost will be zero EBIT. Correct? Contribution minus fixed cost. That is normal cost break even. It is financial break even. Financial break even means I plus PD divided by 1 minus T. Logic, don't ask now. This is not the time. So tell the formula. I plus PD divided by 1 minus T. That's called as a financial break even point. Financial break even point is a value of what? It is a value of EBIT at which EPS will be exactly zero. Next. Financial indifference point. Sir, what is this financial indifference point? Indifference point is a EBIT where EPS under any two options will be same. Sir, what do you mean by two options? My company has two ideas. I wanted to raise 1 lakh new capital, but I have two options. Raise 100% and 1 lakh by equity, 50% by equity, 50% by debt. Okay, answer will be same or different. EPS answer will be different. At what EBIT, both EPS will be same. Is called as a financial indifference point. It is a level of EBIT at which EPS is same under any given alternatives. Okay. First of all, I will give 2 minutes time for you. See all the formulae. Okay. After that, I will show you sample questions. If you have any doubts, you can get it clarified. After that, another 1 hour time you have to spend complete the capital structures chapter. In this way, you can complete a core 15 marks of your portion. Okay, 2 minutes time I will give. Observe all the formula given. I should not see anyone leaving the live. I want that seriousness to stay till the end of this session. Exam is for you, not for me. Okay, again I'm repeating, exam is for you, not for me. Observe all the formula. I'm putting it this way. On this, I will show you questions now. Completed. So let us continue. First one. See here. They will give you this way. See, they will give you multiple plans. How questions will come, I'm showing you. I'm showing you practical problem number four. Directly, you can see the answer. You can understand by seeing this. Okay. You're not that much having no clarity as to what is the question meant to say. You know the basics, but let us try to understand using this answer. They will give you three plans in the question: Plan A, Plan B, and Plan C. Plan B, funding is only through equity. Funding is by a combination of equity and debt. And third one is the funding is by combination of equity and preference. In the first plan, EBIT, EBIT, EBIT will be same. Why EBIT is same in all three options? This clarity you should have first. Why? Because financing will start after EBIT. And in simple language, EBIT minus interest. Interest is a financing cost. Minus preference dividend, minus equity dividend. All this comes below EBIT. And a financing of a company does not affect the EBIT. It will affect only the items below the line of EBIT. Okay. So EBIT will not change whether you finance by equity debt. Okay. Because that interest cost anyway will not come while calculating EBIT. It comes after calculating EBIT. So EBIT under all the three options will be same. If you follow only equity, interest will not be there. If you follow equity and preference, interest will not be there because equity dividend, preference dividend, no interest. But if you follow the debt model, definitely there will be interest cost. EBT tax rate. EAT calculated preference dividend. Here preference dividend will come. EPS, EPS, and EPS. This is the first question. So you will calculate. This is called as EBIT EPS analysis, not indifference point. This question is EBIT EPS analysis. Means what? If you follow only equity for that level of EBIT, this is the EPS. If you follow debt and equity for this level of EBIT, this is the EPS. Okay. If you follow equity preference for this level of EBIT, this is the EPS. This is called as a EBIT EPS analysis. Second question they will ask. Financial break-even point. Financial break-even point. Okay. See, first option is what? Only equity option. Whenever only equity option comes, interest will not be there, preference dividend will not be there. So financial break-even point is zero because formula is I plus PD by 1 minus T. I not there, PD not there. Value will be zero. Plan B. What is it? Equity and debt. Equity and debt. In this case, again, easy answer. Equity and debt means what is not there? PD is not there. In that case, only what will come? I is the answer. Interest is how much? 8,000. 8,000 is the answer. Okay, this is the financial break-even point. Bit 2. Bit 3. Plan C. Equity and preference. In this case, PD by 1 minus T will come. I will be 0. That comes to 16,000. Hopefully, everyone understood the concept clearly. Everybody? Yeah. Next. So this one question, if you do na, you will do EBIT EPS analysis, financial break-even point, EBIT EPS indifference point. Now EBIT EPS indifference point. Whenever question comes on EBIT EPS indifference point, blindly first remember one thing. What is the indifference point concept? It is that level of EBIT at which EPS under any two options will be same. Okay. So EBIT we don't know. Put it X. Okay. I will be here. Three plans are there: A, B, C. Equity, equity debt, equity preference. Okay. Plan A, plan B combination. X, X. Interest not there. 8,000 is there. You calculated EPS. Here I got X minus zero point 0.5, 0.5x, number of shares 10,000, 0.5x divided by 10,000. This is the EPS under only equity option. Equity and debt option, it came to 0.5x minus 4,000 divided by 5,000. Equated x equal to 16. What is this x? If EBIT is 16,000, then EPS will be same whether you finance by equity or whether you finance by equity and debt. Next, plan B and plan C. Very, very important. What is plan B? Equity debt. Plan C, equity preference. These two can't be compared. These two cannot be compared. Comparison should be between only equity, equity debt. Only equity, equity preference. Not between equity debt to equity preference. So that's why comparison not possible. AC, only equity, equity and preference. Again, we calculated, we got 32,000. Everybody understood EBIT EPS indifference, financial break-even point, EBIT EPS analysis. Everyone. So see, in one case, we completed all the questions. So do that practical problem number 4 properly in your textbook. So you will cover each and every point inside. All the details of this EBIT EPS analysis, financial break-even point, indifference point. When indifference point concept becomes incomparable, also you will see in this question. Okay, all will be covered. And again, my suggestion: which problem you need to do after that? Yes, practical problem number 10. Practical problem number 10. Note down. Practical problem number 10. Okay, must to do question in your exam. Okay, na? Next, practical illustration number 14. Illustration number 14. Must to do question in exam. Okay, illustration number 14. Must to do question after the class. Illustration 10, illustration 14. Clear? Now we completed what concepts here? We completed EBIT EPS analysis, financial break-even point, and financial indifference point. Now, fourth one, capital structure theories, net income approach, net operating income approach, Modigliani Miller approach. Okay. First, listen carefully. I wanted to just tell you how one can recognize a question that is given in examination as net income approach and net operating income approach. Okay. Listen, 5 minutes concept explanation. After that, how to present the answers in exam presentation that I will explain. Okay. I repeat again, 5 to 10 minutes. Spare with me. I will first tell you the concept. Concept means I'm not going deep into the analysis again, like in a regular session for 1 hour, 1.5 hours. Okay, 5 minutes I will complete the glossary of this concept. After that, I will tell you how to present your answers and when a question comes in exam, how to understand this. Okay, if an 8 marks question came on capital structure theory, how I should understand this question. Okay, my approach, my thought process should be in what way that I am going to explain now. Okay, listen carefully. See here. So whenever a question comes in examination on net income approach or net operating income approach, first of all, listen carefully. Net income approach says that more debt in the capital structure, I repeat, more debt in the capital structure, lesser will be the KO. Okay, logic is very simple. See here. Observation, please. All are present. I said, don't exit the live. Some are coming, some are going. Don't do like that, yeah. Please, it's very important concept. Exit will make yourself fatal in examination hall. It is always problematic. Please listen carefully. See, how our approach should be regarding the net income approach questions that comes in exam. If a net income approach question comes in examination, how I should understand? Whether this question is a net income approach or net operating income approach, how would I know? Okay. And how I can understand whether this is a question on net income approach or net operating income approach? How would I know? A question will come. See, let us understand. Whenever I say net income approach, assumptions are very clear. Assumption number one, not assumption. Let me tell you the theory idea. More debt in the capital structure. 100 rupees, 80 rupee debt to 20 rupee equity, like that. More debt in capital structure. More will be the WD, and a weight of debt. Okay. KO, total cost of capital, and a WACC. WD, KD plus WE, KE. KE will be always costly. KD will be always relatively cheaper. Okay. Example. If you have 80% debt at 10% rate, 20% equity at 16% rate, what is your total cost of capital? 8% plus 3.2%. 11.2% is your KO. Correct? Next. Reverse it. WD is zero point 0.2. WE is 0.8. 0.2 into 10, 2% plus 16 into 0.8. 12.8%. Tell me what is the value? 14.8%. See how the answers are changing now? So if KO is 11.2, if KO is 14.8, both are changing or not? Change has come because of what? Weight change. Okay. Whenever more debt is there, there will be more WD. More WD, lesser will be the KO. Lesser will be the KO. What is the value of the company formula? EBIT divided by KO. Just now we saw the formula. Na? Let us say EBIT is 1000. Okay. First case, 1000 divided by 11.2%. 8,929. Like that same. 1000 divided by 14.8%. 6,757. 6,757. 6,757. From this, what you understand? More the KO, lesser the value. Lesser the KO, more the value. KO and value of the company are inversely proportional. So, net income approach says more debt, more WD. WD. More WD, lesser the KO. Lesser the KO, more the value of company. Reverse. Lesser the debt, lesser the WD. Lesser the WD, more will be the KO. More the KO, lesser will be the value of company. Okay, one should observe the relation between both of these. Inversely proportional. Inversely proportional. From this, what you understand? From this, what you have to understand is whenever more debt is there, more WD will come. More WD, lesser the KO, lesser the KO, more the value of the company. Lesser debt, less WD, more KO, lesser the value of the company. This is the thesis of net income approach. Up to here, everyone, please say understood clearly or not. Understood the explanation up to here clearly? Very nice. So from this, what you understand, whenever high debt is there in capital structure, value will be more for that company. Okay. Always remember in NI approach, KE is constant. What do you mean KE is constant? KE is constant means whether you have more debt, whether you have lesser debt, KE is always a constant. KE is always a constant. Okay. K is a constant. value of the company is a variable. Means what? Value of company will increase with increased debt, reduce with reduced debt. Okay, this is the concept. In case of net operating income approach, see, listen, this is main twist. Under net operating income approach, they say like this: more debt, more WD. I agree. More WD, lesser will be KO. I agree. Lesser the KO, more the value of company. We agree. Sir, we agree means this again same na sir. No, they said along with this, another thing also will happen. More debt, more finance cost. Who will bear? Owners have to bear. Because try to understand, debenture holders want. Okay, debenture holders look for. Okay, debenture holder look for EBIT, EBT, EAT, EISH. Answer. Debenture holders look for EBIT, EBT, EAT, EISH. They look for what? Debenture holders. Okay. So many answers you have given. The right answer is all answers are wrong. They look for interest. They don't look for EBIT. They don't look for EBT. They don't look for EAT. They don't even look for EASH. Asal, they don't even look for sales. Whether you make sales or not, pay me interest. Whether you make contribution or not, pay my interest. For example, I took a loan from a bank for a housing loan, for a housing purpose. Later, I was removed from my job by my company. I became jobless. I have no salary. Okay. Yo, Kaushik Mukesh lost his job. Salary is not there. So let us compromise my EMI. Banks will never tell that. Whether you have salary or not, whether you have contribution or not, you pay my interest. Yeah. So from this, what is the moral of the story? Debenture holders do not look for EBIT. అది అంతా డొరల. Okay. Ambak. Just for the sake of show put up in classroom, we will tell like that. But in reality, nothing. They want only one thing. What is that? That they require only interest. Okay. They require only interest. If you pay interest, na, that's it. They are very happy. Whether you make EBIT or not, also they don't see. You pay my interest properly. Okay. I gave you loan. On that, you pay me fixed interest. That's it. So, from this, what is the moral of the story? You have to understand, debenture holders do not look for EBIT. Okay, whether EBIT there or not there, you have to pay them interest. Ante, getting EBIT is the headache of whom? Equity. Sales happened, equity will be happy. Sales not happened, risk will be taken by equity. Ante, entire business risk, entire finance risk, who is taking? Equity. Whenever the more debt is infused in the capital structure, automatically what will happen? More interest they have to pay. EBIT may pay, may not pay. So therefore, the entire risk is always taken by equity. That is propounded in this particular NOA approach. What net operating income approach said? More debt, more WD, agreed. More WD, lesser KO, agreed. Lesser KO, more value, agreed. But we don't agree fully. There is one more point to this. Tail is attached. More debt, you said, na? Whenever more debt is infused, there will be more KE. KE is a constant here. KE changes here. Whenever in the exam, okay, KE is given in the question already. It is a net income approach question. KE is missing in the question. That's net operating income question. Ante, this is how you should understand. I'm talking to you, everyone. Understood? So, therefore, what they say in net operating income approach, in net operating income approach, they will say that, okay, more debt. more KE, more KE, more KO, more the KO, lesser the value of company. What happened in the first case? More debt, more more WD, lesser KO, value increase. Sorry, value increase is a plus. More debt, second effect, more debt, more KE, more KE, more KO, more KO, lesser the value minus. If plus minus offset each other, value of company will remain constant. Net operating income approach la constant is the value of company. Net income approach la constant is the KE. It is the concept that you have to understand. Everybody understood this logic clearly or not? How to understand which question they gave in exam? Yeah. So this is the whole logic behind this particular concept. Yeah. So one should understand very clearly how question was given in the exam. Okay, identification whether this came from net income or net operating income. In the question, if they say clearly net operating income, it's net operating income question. But generally in exams they don't tell that. So in that case, how to observe? This is the way to observe that. Okay. Okay. I will show you two questions. How many? Two questions. See, but I don't want to spend a lot of time on this. Yeah, 2 minutes I will spend on each question. They will give question like this, sir. Entire capital structure chapter la some assumptions are there. Some assumptions are there. It is no preference. It is no preference, and complete dividends are distributed as earning. Complete dividends are distributed as earning. And there is no concept of retained earning. Directly earning came a complete EAT will become EISH. Are the assumptions of this particular entire chapter. Okay. And listen carefully. They will always give you two company details. Okay. They will always give you two company details. Both are similar in all the aspects except for their capital structure. Until one company will be all debt company, one company will be all equity company, one company will be debt equity company. Okay, you will compare both these companies and tell how the values will change because of capital structure decision. Like this, if I tell theoretically, you won't understand. See this question. JM, two questions. Two companies. I'm very sorry. Two companies. I will give you one word. If you can do this question, any question that comes in examination, you will do. Yeah. You can mark my words. If you can do this question, any question that comes in examination, you will be able to do. This is a sample question I have taken from CFA level 1. Those who have taken regular classes for FM, you will know that this question. Who are seeing for the first time, at least observe now clearly. Okay. See, what is the question? EBIT they have given. Because I said both companies are similar in all the aspects. So because of that, EBITs are same. But one company is debt financed, one company is no debt finance. KD 10%, no. KE they did give 15. KO they didn't give 15. What I said, if KE given in the question, it is a net income approach question. Net income approach question. In net income approach, KE is what? Constant in both the companies. So 15%, wait, 15% here means 15% also here. Okay. KO. 15% here. How much is here? We need to calculate. Okay. In case of net operating income, value of the company will be same. Value of the company will be same because of this. KO increase, KO reduce. Okay. Then KO is constant. Value is constant. So in net operating income approach, KO is constant. KO is a constant. But net income approach, KO we have to calculate. How to calculate? Let us see. These are the data. EBIT, debt, KD, all these are given. First of all, always remember, see, whenever a question is given on net income approach or net operating income approach, first of all, a common schedule you have to draw. Schedule looks like this. Particulars, company J and company M. Start the income statement. EBIT minus interest, EBT minus tax, EAT or EAESH. Then B, sorry, KD, KE, KO, B, S, V. These six missing figures. In that, some data they will give. See, easy way of doing this. First, what you have to do? Stage one, income statement. Stage two, cost of capital. Stage three, valuation. Three stages we have to do the answer. First stage, income statement. Second stage, cost of capitals. Third stage, valuation stage. And the three stages the answer. The net income, net operating income doesn't make any difference. Okay. So answers will be changing, but the schedule format will be same. At the time of examination, what we require, I should pass my exam here. Okay. So how to pass? Remember this. EBIT. How much they have given? 3 lakh. 3 lakh. 3 lakh. If you do one problem, you will get a clarity. 3 lakh and 3 lakh. Interest. In one company, debt is there. 90,000 into 10%. 9 lakhs into 10%. 90,000. Not there. 2 lakh 10,000. 3 lakh. Tax. How much tax given in the question? Tax not there. Na? Okay. Tax not there. So 2 lakh 10,000. 3 lakh. Okay. KD. 10%. 0. KE. 15% given here. Okay. Anyway, in net income approach, debt increases, na, KO reduces. That's it. KE is always a constant. 15, 15. Okay. Now, you know the formula. You know the formula. KO, you forget. I'm not asking about KO. I wanted to ask you the value of debt. B means value of debt. How much? 9 lakh. Here, 0. Next. Yes. Yes equal to formula. EAESH divided by KO. EAESH divided by KO. See here. In one company, KO is already given. How much? 15%. Okay. Since it is all equity, na, KEA, KO. What is the value of this particular company? Yes, sir. See. EAESH 3 lakh divided by 15%. 20 lakh. Equal to how much? 20 lakh. Value of company M. Okay. Means all equity finance is 20 lakh. Total value of the company also will be 20 lakh because this will be B plus S. Okay. Over. Next. KO calculation we need. We know this. Value of company equal to EBIT by KO. EBIT by KO. Correct? Value of company will be EBIT by KO. Here, how much is the KO in this particular case? KD is there. KE is there. KO we need to calculate. Value of the company. Value of the company, total value of the company is a combination of value of equity plus value of debt. See here clearly. See here. Direct calculations I have done, it will be easy for you. One already I calculated, 15%. See, 9 lakh, 90,000, 2 lakh 10,000, 2 lakh 10,000, KE 15%. KE 15%. Common, na? So what will happen now? EASH divided by S value we can calculate. S equal to EAESH divided by KE. KE 15%. EAESH 2 lakh 10,000. That's it. So 2 lakh 10,000 divided by 15%. 14 lakh. What is 14 lakh? Value of S. Total put together will be 23 lakhs. So KO equal to, interchange this formula, EBIT by V. EB8 is how much? 3 lakh. V is 23 lakh. 3 lakh divided by 23 lakh. 13.04%. 13.04%. In the theory, what I said? In the theory, what I said? More debt, more value. More debt, more value. You got only 20, I got 23. Next, what I said? More debt, lesser KO. More debt, lesser KO. I got 13.04, you got 15. Hence proved. This is the net income approach. So the four formula, if you have in your mind, you can do any kind of question that comes in exam. Everyone understood real up to here. Everyone understood up to here. I shown you the presentation. I shown you the answer as well. Everyone understood net income approach. Yeah. Next, same question. Net operating income. Let us see. Which one? Net operating income. I will show you directly here itself. Okay. In net operating income, what will happen? More debt, more WD, more WD, lesser KO, lesser KO, more the value. But it doesn't end here. More debt, more KE. Because of more KE, KO will reduce. In one way, KO increase. In one way, KO reduce. Offset each other. KO is constant. When KO is constant, value of company will be same. Okay. In one way, value increase. In one way, value decrease. Both will be same again. So in case of NOI approach, value of companies will be same. KO also will be same. What is company M? All equity. All equity means only equity will be there. And KEA, KO. KE, KO. KO is anyway same in both cases. 15% will be taken also here. KE will become the missing figure. Here KE is not a constant. More debt companies will have more KE. So same calculations. We got 19.09 as the KE for J and we got 15 for M. Okay. I have given full explanation in the material. Whenever you find time, you can see and you can complete this. Okay. Next. Any kind of question. Same formula. Those four formula, if you have in your hand, you can do any kind of question. My recommendation, which questions you need to do. Okay. For practice now, in that 1 hour time, what are the questions you need to do? I recommend you to do question number 5. Yeah. Very important. Question number 5. And then do question number 4. My example question you must do. After that, 4 and 5 are recommended questions to do. Next, I will go directly into another area and then come to MM approach. See, whenever taxation is involved in capital structure theories, listen carefully. Whenever what is involved? Whenever taxation is involved in capital structure theory, the entire concept will change. NI approach says, listen carefully, NI approach says more debt, more value because debt is a cheaper cost of capital. Because of that, lesser KO, more value. Again, now it becomes much more possible because whenever taxation is involved, NI approach already said KD is lower. Okay, because of cheaper cost of finance. It becomes much more lower because of taxation because it gives a tax saving to the company. It gives a tax saving to the company. From this, what you have to understand, whenever more debt is there in capital structure, that companies will have magnified value under NI approach because NI approach will become more stronger. Already NI approach say more debt, more WD. More WD, lesser KO. Because debt is cheaper cost. K is 16, అయితే debt is 10. But debt is not even 10. 10 again 30% tax saving, it becomes 7% only. KO will much more reduce, value will much more increase. So NI approach become more stronger. NOI approach now turns around. Under NOI, what we said? Under NOI, what we said? Everyone, more debt, more WD. More WD, more KO. Sorry, very, very sorry. Lesser KO. Lesser KO, more the value. Perfect. Then what we said? More debt, more KE. More KE, more KO. More lesser KO, more KO. That decrease in KO, this increase in KO, both offset each other. KO is a constant. Next, increase in value, decrease in value, both offset each other is a constant. Correct? This is what we understood. But when tax is involved, what will happen? Third impact also will be there. What is the third impact? More debt, more WD. More WD, lesser the KO because tax saving is also involved. Then more the value. Then what has happened now? Previously, one downward pull, one upward pull offset each other. Now, two downward pulls are there, but upward pull is only once. Two value increases are there. Only one reduction in value increase is there. Two times I will increase, or two times I will pull to the upward direction. One time only you will pull to the downward direction. That upward pull is more stronger than downward pull. Therefore, even under NOI approach with the taxation, when debt is involved in the capital structure, value of the company will be more. They understood the concept clearly or not? This is not a regular class. I can't repeat n number of times. Hopefully, everyone understood. So, without taxation, NOI approach says that more debt, more value. With the taxation, without taxation, NOI approach say whether debt or equity value is constant. But with the taxation, NI approach becomes more stronger. They don't change their word. They said more debt, more value. Now, tax is there much more value. NOI approach says that value is constant. Now it will also say that value will be more for companies having debt. Understood? Right? Yeah, let's begin now. So, what is the logic here? So, whenever debt is there, we call it levered company. This theory says that NOI says that whenever the company is a levered company with the taxation, the value will be value of unlevered plus B into T. That's formula I shown. Here only you should use that. Okay. Let us take one question and see. Let us take one question and see. See here. Is the question. Okay. With the taxation. Tax is 50%. First, let us see NI. EBIT same. Interest, EBIT, tax, EAT. Okay. Like this, we valued. Finally, we got the values as 9.375 and 15%. This is the NI approach. I don't want to discuss about this much. Let us see NOI approach, which is very, very important. EBIT 3 lakh, 3 lakh, interest deducted, EBT same. Tax deducted, EAT also same. Okay, EAT also same. Normally under NOI, what we said, KO is constant, but now we can't take that constant because tax is involved. Therefore, first we need to know the value of that levered company. Here, J is the levered company because it is having debt. Value of levered company equal to value of unlevered plus borrowing into T. So 10 lakh is the value of unlevered company plus 9 lakh is the debt to 50%, 14 lakh 50,000 is the value. Using that V, you will calculate the remaining missing figures. That is your work you need to do after the class. All workings I have given here. Everybody understood the concept clearly or not? Everyone understood clearly? Yeah. This is the whole idea behind this particular concept. Okay. So this is the end of the chapter, capital structure theory. Sir, Modigliani, sir, already revision video I uploaded Modigliani Miller. Tomorrow, when you are doing the today, your target 15 marks now, night. What are the topics? Cost of capital, fully you have to complete. Capital structure, fully you have to complete. Okay. Next, there is one small theory area called as a scope and objectives of financial management. What is the concept? Scope and objectives of financial management. That small area will be there, a theory chapter. These are the three topics that we have to cover now. 15 marks is our target. Okay. Modigliani Miller, what you need to do. Modigliani Miller, recently I kept one revision video on FM there. So use that revision video properly. Go directly to capital structure, Modigliani Miller. 35, 40 minutes like complete entire MM approach. Listen to that. Do the questions, solve RTP. 15 marks will be yours. Now the time is 11:20, almost 11:18. Let's say 11:20. 11:30 you should start. 12:30 cost of capital. 1:30 capital structure. Don't sleep before that. Okay. Do the 10 sleep. Take 5 hours rest. Enough. No problem. No one will die. Take 5 hours rest. Wake up. Start first with FM. Do a chapter called as dividends and leverages. Dividends and leverages. Leverages 1 hour, dividends 1 hour. Complete it. Leverages 1 hour, dividends 1 hour. Complete. Another 10 marks will be covered there. After that, you start your SM. Again, night, start with ratios, capital budgeting. Like that, you need to do. Okay. Tomorrow, 90%, I will again come up live. Not for these chapters again. I will come for one difficult area called as a capital budgeting. Important adjustments and other things I will give. Yeah. Or else, if you find no time, you are very busy in reading SM, FM, etc. Revision videos are already there. Please go through them. My target is my presence should give you 15 marks. 15 marks is not a joke. Okay, your 45 becomes 60 because of that. Your 30, your 25 will become 40 because of that. Okay. So thank you very much. Don't waste your time, please. Time is very, very precious now. Prepare well for your examinations. We will all see you in CA final AFM and CA final income tax. Thank you very much. All the very best. God bless you all. Love you all. Prepare well. Please don't waste time. Don't waste time in sleeping now. Okay. Please be active. Do your subject. Okay. So thank you very much. Thank you. All the very best. Don't waste time in YouTube. First, go out, everyone.